Hello, welcome everyone. Welcome. Hi, I'm so happy that you can join me today. All right, is everyone ready? I'm going to wait like 1 or 2 more minutes to let more people join, and then we will get started, but thank you so much. Welcome. Anyone wants to chat? Hey, where's everyone from? Is it all Chicago, Atlanta? You can type me in the chat. Chicago, all right, Nicole. Hey, Chi-Town, yes, thank you. All right, Andrea, how are you? So nice, I'm so happy that you can join me today. Chi-Town, yes, thank you. Oh, Philly, hey, Sharon, Philly, awesome, that's amazing. Yes, all 50 states, because your federal taxes actually are the same. And as a business owner, you definitely want to know about your taxes, and the federal taxes are all the same. There's Danita. Hey, Danita, how are you? Thank you for joining me. Hey, welcome. So if you own a business, type B in the chat. If you own a business, type B in the chat. I want to know how many people actually own a business, or if you're thinking about owning a business, maybe type a T, just so I kind of know who my crowd is. All right, B's for days. All right, hello, Ali, how are you? All right, we own businesses. That's so awesome. So I have a treat in store for you today, because I'm here to give you some education about your business and your taxes, and what I feel every successful six-figure, even if you're on your way to six-figure, multiple six-figure, seven-figure business owner needs to know about their taxes and financial statements. Because honestly, with it all, your financial statement is a big part of the taxes and the tax strategy. And you keeping documentation is what allows you to protect your return from the IRS. So we're going to talk about these things today. You may hear some things you never heard of. Yeah, you may learn something new. And then at the end, we're going to have a big Q&A session, so you can ask me whatever you want to ask and kind of are curious about as it relates to your business, your taxes, and your financial statements. Okay, 7:03. I'm going to wait 1 more minute just to see if people join me or if they're ready to join. And then I'm going to get started. I'm going to share my screen. Okay, so I'm gonna share my screen, and all right. Okay, so we're about to get started. So what every financially savvy business owner should know. And presented by me, Deanna Grant. I'm actually the owner of Grant's Financial Services, and I have a personal brand called Tax Boss Lady. That is near and dear to my heart because, one, I'm a boss lady and I love taxes. So I picked my Instagram name just because of those two things. And then it kind of just stuck with me. And I love pink. Pink is passionate, pink is powerful. And so that's my favorite color, and I love wearing it. And that's where we are today. So let's get started. What every financially savvy business owner should know. Okay, now first let's hear a little bit about me. I'm a CEO and founder of Grant's Financial Services. As I said before, my mission is to empower and educate women, entrepreneurs, and people of color to get to their first million in revenue so they can make a difference in their lives, their businesses, and create family generational wealth, as well as be a support to our communities. If the businesses in our communities, if they could sustain longer instead of going out of business, and basically had a tax and accounting strategy just to remain in the community and just understand how to grow their business, then that's an awesome, powerful story. I'm definitely a community leader, and I love our community, and I want to see more of our businesses be successful and remain and sustain in the community. Who am I? I'm an owner of a multiple six-figure tax business. I'm a business financial coach and speaker on topics of tax, cash flow, wealth building, financial literacy for underserved communities. I help 6 to 7 figure business owners save an average of 10 to 20K in taxes annually. Yes, 10 to 20K in taxes annually with tax strategies. I work exclusively, well, I have individual tax clients, but my heart is with small business owners, and I've been doing that for the last 20 years. How I got started was I actually worked at a firm. So instead of me going to like Deloitte and Touche or one of the bigger CPA firms, I worked at a small Black accounting firm named Dorsey, Norman and Associates. And that is how I learned everything. And we worked with the who's who of the Black community at that time. And then I transitioned from him, and then I started my own practice. I've been in business for 10 years, and it's been a journey. And I prepared personally, I could probably guarantee this, 10,000 individual and business tax returns combined, and have seen refunds of millions of dollars. Okay, so what every CEO should have a tax strategy and be the boss of your finances. Just like those bossy heels, and we purchase those bossy heels, we also want to be the boss in our business finances. We want our finances to look just as good in our business. Okay, so today we're going to talk about how I started my business, business entities. I'm going to break down the different types of entities and explain that. 5 mistakes I see that business owners make, books and tax records, tax strategies for business owners, and hire an accountant. Okay, so this is me. That's my business, Grants Financial Services. We're in Chicago, 2008 South Wabash. But I'm a mother. I'm also a divorcee, and I started my business through a divorce. So what happened to me, there were 3 things that happened to me all at one time. This was right at the last market crash. So it's COVID this year, but when the real estate market crashed, 3 things happened to me. I lost my job. I was married at the time. My ex-husband left the house, and then we eventually got divorced, but all in the same month. I lost my job. Then my ex-husband leaves the house. Then my father passed away. I believe this was like in 3 weeks, back to back to back. And this was the most devastating time of my whole life. I didn't know what to do. Everything that made me feel secure, from a marriage, a job, and my parents, because my mother passed away when I was 11. So my father was my parent, my main parent, and he passed away. Everything that made me feel secure was gone. It felt hopeless. And so then I was like, I'm gonna start a business. And that's how I got started. I actually started in my home. I had 10 customers. I wanna say Danita and her sister were like customer number 12, but I started in my house at my dining room table, and I got a business card and a smile, and I just started telling everybody about Grants Financial Services and that I do taxes, and it grew from there. We started with 10, we processed over 400 customers and growing, and now I have a really strategic heart or mission for business owners, and we're going to help business owners, help them achieve financial success by helping them help them make money, organize their business financials, and save tax dollars. So what my little spiel is, we offer a stress-free tax filing experience. Okay. What is a business entity? We hear about these business entities all the time, and we never kind of understand what is what. But there's several different business entity types. There's a sole proprietorship. With the sole proprietorship, you could get started now. So do not let anyone say you need to incorporate to get started on your business. No, you can get started today. A sole proprietorship, what happens is you operate through your social security number, or you could even get an EIN number for that. But a sole proprietorship is an unincorporated business. So you can get started tomorrow in business. Don't let anything stop you. Then the next thing is an LLC. Now, what's most popular is a single member LLC. A single member LLC means it's an LLC with one person. So that is a single member LLC, and a lot of people are going to the Secretary of State and they are filing an LLC. And if they're the only owner, they are considered a single member LLC. Then there's an entity called the S Corp, and actually that is a strategy, not necessarily an entity. We'll get into that later. Partnerships are like LLCs with 2 or more members. That is a partnership. If you are a husband-wife couple, actually you're considered a single member, because I guess 2 become 1. Or if you like to, you can elect to file as a partnership as a married couple. And there we go. And then there's corporate. There's a corporate return. Okay, so there are levels to this. Your choice of entity. So we just talked about the different entity types. And what I want to say in business and entrepreneurship, there are levels to entrepreneurship, and basically your choice of entity equals a tax strategy. And you kind of start off, there's level 1, 2, 3, and 4. So level 1, I want to consider it like a baby. So like you're a baby in business and you just got started, you're starting making money, and you report it as a sole proprietor. But then I would say once you start making 10K or more, just to protect your interest, and or if you know, if your intent is to make money in your business, then I would become an LLC right away. And I actually like LLC. LLC is my entity of choice. Why? Because an LLC is a disregarded entity. And as an LLC, I actually, as a tax strategy, I can elect to tax your entity as a sole proprietor, tax it as an S Corp, or it could be taxed as a C Corp. So that also is a strategy, but an LLC can be taxed in any of those ways. So that's why I feel like it's level 2. Because if you have the LLC, we're at level 2. Level 2 for me is income or profit between 10 to 25,000. And I think you should remain a single member LLC between 10 to 25,000, sole proprietor between 0 and 10,000. And this is profit. Profit means after expenses. Sole proprietor 0 to 10, single member LLC 10 to 25,000. And then the next strategy is S Corp. And we've heard so much about this, but an S Corp is an election. It's a tax election. What happens is you file a form with the IRS so that you can be a subchapter S corporation. And then this is a tax saving strategy. Then there is level 4. So this is when you're making, I don't know, 6-figure profits, maybe even 50,000 to 100,000 of profit after expenses. And then we're going to use a combination of these strategies so that we can save tax dollars. So I may elect for you to have 3 strategies, 3 tax entities, S Corp. I like S Corp, C Corp, and a nonprofit as a triangle, but it's a great tax strategy. And I float money in between the entities and will save tax dollars. Okay, and then that is my $1 million entity, multiple entity strategy. So C Corp, LLC, and not-for-profit. For me, that's the wealth formula as we're trying to build that generational wealth. Okay, I want to see if I have any questions. I want to see, no Q&A. No, I'm sorry. I hate that I'm still getting used to this technology. Okay, now for all of these entities, what a lot of business owners don't understand is when are my taxes due? So this is very important for you to file your taxes on time. And if you don't have time to get your paperwork together and file your taxes on time, then you should elect to do a valid tax extension. If you are a sole proprietor, you file your taxes, they're due April 15th. Sole proprietors, their business is reported on their personal tax return, Form 1040. If you are a single member LLC, your taxes are due April 15th. As a single member LLC, your taxes are also reported on Form 1040, and they're due April 15th. So single member LLC business owners, your taxes are reported on your personal tax return, and they are due April 15th. If you have an S Corp, and this is when I said when your business profits are between 25,000 and 50,000, actually 25,000 up to 100,000 of profit, we would elect to do the S Corporation strategy. That tax return is due March 15th. Partnership, the tax return is due March 15th. Corporation, your tax return, I'm sorry, they're actually due April 15th. This year it was due July 15th. But in each scenario, if you do not have your documentation together, you should file an extension. Don't get overwhelmed, don't get stressed, don't do nothing, because it costs you money when you do not file your taxes on time. There is penalty to file, late filing penalty. There's a penalty for not filing, there's a late filing penalty, and there's a late payment penalty. So there's no reason for you to incur these extra fees and costs when we should just file an extension and get our paperwork together. Okay, let's talk about making and managing money. Now, I want to talk about this first because part of having a great tax strategy is having good books and records. If you do not have good books and records, you cannot have, I'm sorry, I finally found the chat. So the corporate taxes, the corporate taxes are due April 15th, like the personal tax return. So a corporate tax return is due April 15th, and the S Corp tax return is due March 15th. Corporate tax returns are C Corp, so not the S Corp. The S Corp is due March 15th. Okay, so hey, let's talk about making and managing money, because part of tax strategy and me being able to help you implement tax strategy is you need good books and records. And these are 5 mistakes that I see business owners making all the time. And we just want to go for it. So mistake number 1, not having a financial plan. That's a mistake. You're in business and you're winging it and you just have no idea. And a financial plan, to me, it does not necessarily mean a whole business plan. I would love for you to have a pro forma, a 12-month cash flow projection. However, just having a financial plan, I actually had a consult with a young lady, and we just were talking about her inventory and making a way to sell the inventory. And for me, that is a financial plan. If you have a product or service, you need to know, how much money do I want to make in my business? And once you know that, then you can fill everything else out. What is a pro forma? Okay, Bridget. Hey, Bridget. A pro forma is I call it a cash flow projection, but a pro forma is a plan where we take accountants, where we take 12 months of your financial information, and it's almost like a budget for 12 months. So what we do is we create a financial plan January through December, and we project what your sales are going to be, as well as projecting what those expenses are going to be, and we get a 12-month glance at your finances. And this is how we can predict we could also predict shortages. So we may know that this business is seasonal, and that in the month of July, once we do this 12-month plan, we can see that in July, sales are typically slower in July. And now we can make a plan to have a social media blitz strategy, a marketing campaign, so that our sales do not have to be lowered in July. But it's basically a 12-month financial plan, almost like a budget of your business income and expenses. That's what a pro forma is. But mistake number 1 is not having a financial plan. So mistake number 2, not having enough cash flow. So this is a mistake. Sometimes we think that, I understand bootstrapping in your business, and what bootstrapping is just say you have a W-2 job, so all of your personal bills are paid. but not having enough cash flow means that your business has more expenses than income. And sometimes that's what happens because we actually need to invest in our businesses. An investment is where you put money in first, then you reap rewards and results. But when you don't have enough cash flow, a lot of businesses, they get frustrated. And instead of getting frustrated, why don't we indicate exactly how much money do I need? And if you need to get more money, then unfortunately, I have to give you the rules of hard knocks. You're gonna have to find a way to get the money, get some money. So what that means is Uber. I know we're in COVID, sorry, but there's Uber. There is selling clothes from your closet. There is, I don't know, overtime at the job. There is maybe increasing your prices, but you have to have enough cash to run a business. Cash is king in a business, or you need access to capital. But this is mistake number 2, not having enough cash flow. Mistake number 3, no financial management system. And I don't mean to do like this, but I see a lot of business owners, and we're in business, and basically, if you want to simplify it, you can have your financial management system could be a simple spreadsheet where you keep track of your income and expense on a monthly basis, but then we could step it up into the next level, which is a computerized software system. And I'm going to talk about some systems that I like in a minute, but that's a mistake, not having a financial management system. Mistake number 4, and I put all these things on the side, but taking advice from your girlfriends. I see this all the time. I got a story for you ladies. So I had a client, and this client, this was a non-COVID season, and she is my tax client. She was at the office cooler or whatever it is at the little coffee on a break with her coworker. And she had just got married. So she's excited she just got married. Then her coworker was like, man, if you file married filing separately, then that is, that's the worst thing you could ever do. Or I think it was if you file married filing jointly, that's the worst thing you could ever do. So then I asked my tax client, I was like, okay, is your friend married? She was like, no. I was like, okay, I was done right there. Then I'm like, okay, does your friend have any formalized tax education or anything like that? Does your friend do taxes? The answer is no. So taking advice from friends, unless they are qualified professionals in that area of expertise, I don't know if I would do that, but people do that all the time. I want to tell you, as a professional, there's so many tax forms. I put this on the side for a cheat sheet. There's so many tax forms that you business owners don't know about and why you should use a professional. There's 1040, 1065, 1120S, 1120, 7004, 4868, 941, 2553, CP 2000, 9465, 843, 47, and then I said there's over 475 tax deductions and credits. But a professional, or the right professional, knows about all of these things so that you can have in all of these forms, all of the tax code, the professional knows about it, and that is how we're able to implement tax strategy. Okay, mistake number 5, not paying your taxes. People are like making 5-figure months, 6-figure months, and not setting money aside to pay the taxes. That's a mistake, and that will get you in trouble each and every time. Okay, and the next thing I want to talk about was financial order. And there is a methodology that we use. It's basically based off of a book called Profit First. And so far, this is a system that I really like a whole lot, and it helps a business owner get organized financially. And what happens is, in the Profit First method, every time, and I'm just going to tell you a simple formula because it can get more detailed than this, but I just want to tell you a simplified method to calculate this. So just say in a month's time, what you do is you set percentages for different bank accounts. You create 3 bank accounts. You have your business account, your regular business account, operating account. You have your tax account, and then you have a profit account. because a lot of us business owners, we work, and we do not pay ourselves anything. So with a very simplistic example, just say for the month you made $10,000 in your business for that month gross. Now I'm going to do a simple method because your percentages need to be calculated exactly and in an exacting manner. But for today, this is a simple way to at least have money set aside for taxes. If you have a $10,000 month, what you simply do is you align a percentage. Now your tax percentage is based off your tax rate, but let's just go with simple numbers. We align a percentage. So your profit is 10%, your taxes are 10%. So what happens is if you made $10,000 in that month, at the end of the month, you have a financial date night with yourself and you take $1,000 and you transfer it to that tax bank account. Then you take $1,000 and you transfer it to your profit account. This allows you to just basically, now you have to budget your business off of the 80%. It's kind of based off of the 80-20 rule. So now you have to make business decisions for staff, for supplies, for marketing with the 80% because you took your profit off top and as well as you took the money for taxes, you put it away because that is a struggle for entrepreneurs, saving money or having money for taxes. Now, if we do some strategies, we may not owe as much, but I would say it's very hard for a business owner to owe less than 10% of taxes. Okay. This is what I want to say about your financials. What you do not know, you cannot grow. If you do not know your business profits on a monthly basis, how do you know if you're headed in the right direction? If you don't know your monthly expenses, how do you know what money you could spend on contractors and staff? If you don't know your business financial numbers, how can you evaluate future plans and make business decisions? This is why you're stressed, you don't know, and you're kind of like, you're hustling, you're hustling, but not making data-driven decisions. And I can understand the frustration, but it's very hard to grow your business and you don't know your numbers. Or what I will say is it's kind of easy to get to that first 6 figures, believe it or not. You hustle your way all the way there. And honestly, I kind of know this firsthand. You hustle your way there, you get there, and then now you must know your numbers because you have to add team, you have an office, you have software costs, you have all of these costs that you need to know, and you want to be profitable. You want to be profitable. And if you don't keep track of your numbers, it's hard to see what your profitability is because you're in business to make money. When you don't make money, when you're in business with a loss, what you're doing is you're in business working for your vendors. You're in business, if you have a retail store, you are in business to work for who's like, I don't know, Forever 21. I'm sorry, I don't know any merchant services today. But you're in business working for your vendors, not for yourself. So that's one reason why you want to utilize that profit first methodology so you can make sure that you at least pay yourself. And then secondly, it's just important to have profit in the business. Okay. And actually the IRS tells us that you have to have good books and records, but keeping good books and records. And I have this little picture. Is this financial order? Is this order, all these receipts just kind of not organized, not sorted, not in the right place? Is that financial order? Is this a business boss, how a business boss keeps their financial records in their business? Okay. This is one of my clients. They're kind of like a little, I want to say very organized. They're actually a professional organizer. And then on the left is my professional organizer. And he organized all his receipts January through December. This is the old picture. And then he had everything allocated on the outside of the envelope. So to me, this is a financial system. Maybe it's not the best system. It's not electronic, but it is a financial system. So he took his receipts every month. He would sort it by category and then give totals. And he had it for the year. And that's how he presented to us. Then we have this situation on the right-hand side. And this, back in the day, us accountants, we used to have this, I used to call it the big ugly box. So the client would come to your office with this big ugly box, and then I would put all the records on the table, sort them by category, and then get Excel spreadsheet. But bosses, ladies, gentlemen, if we got gentlemen joining us, we need financial order. We have to do better than this. So income minus expenses equals net profits, because what you don't know, you cannot control. And lastly, because we're supposed to talk about taxes, why should you keep good books and records? Actually, the IRS says everyone in business must keep good books and records. It's actually an IRS rule. And what happens is, if you don't keep good books and records, this gets you in serious trouble, tax trouble. And you just do not want that smoke. You do not want that to happen. But if you keep good books and records help you monitor your business, prepare your financial statement, keep track of your deductible expenses, prepare your tax returns without frustration, and support the items on the tax return. And that is very important, because having tax audits is real. So when you don't keep those records, what happens is you're really throwing money out the door by not keeping your receipts. I just wanted to say again, you're in business to make money. Profits are everything. And accounting is the language of business. The money, you're in business to make money, and the money is the heart of the business. So profits are everything. Here we go with some financial systems. Here are some financial systems that I want to recommend. There's two of them there's one that's free for sure. Expensify is free. And what happens with Expensify is you take your little cell phone device, you download the app, take the cell phone, and every time you have a receipt, you snap a picture of the receipt, and it uploads to Expensify, and then it gives you an itemized report. So if you don't have anything, at least do the free app, Expensify. My software of choice is Intuit QuickBooks, but there's also something called QuickBooks Self-Employed. If you have a single member LLC, you can utilize QuickBooks Self-Employed. Now, of course, everything depends. It kind of depends on your business, depends on the activity in the business, and depends on the reports that you want. Before I would recommend QuickBooks Self-Employed, but I find if you have nothing, please use QuickBooks Self-Employed. There's TaxBot. I like TaxBot a lot because there's a nice little mileage tracker. Actually, QuickBooks Self-Employed has a nice little mileage tracker as well. There is Xero. I know a lot of e-com businesses use Xero. You can Xero, and then there's FreshBooks. A lot of consultants use FreshBooks. What I love about FreshBooks the most, as a consultant, if I send my invoice, then when I look at my accounts receivable invoicing panel, it tells me if the client even opened it. I'm like, hi, I sent you this invoice and you didn't open it. I see that you didn't open it. So anyways, those are some softwares. But I want to go back to what does it cost me when I don't keep my receipts? So if you are in a 30% tax bracket, for every $1,000 of receipts that you do not keep in the calendar year, so that is from January to December, if you're in a 30% tax bracket, that costs you $300 of tax savings. So that's $300 that you could save. And just imagine now it's $10,000 or whatever it is. If you didn't have the proper documentation for your expenses, then it costs you. I also want to talk about mileage. Now, mileage is a very good deduction in taxes. And however, businesses get audited, especially single member LLCs, and I'm sorry to say that, the single member LLC and the sole proprietor gets audited a little bit more than an S Corp or a partnership return. And it's just the nature of the business. One, because people with their sole proprietor, they can get TurboTax and hook their return up. And so the IRS audits those a little bit more often. And so, but what you want to do is not worry about the IRS auditing, but make sure your documentation is in order. Having proper documentation is essential, because if you get audited, I had a client, they got audited for their mileage records, because actually the tax return asks you, did you keep a mileage log or mileage records? And there is an app for that. There's an app called Mileage IQ. there's that app TaxBot, and then there's QuickBooks Self-Employed. I'm pretty sure there's more apps on your app store that keep track of mileage. Mileage is a very good tax deduction. But my client got audited and they had no records. And so what happens is the auditor will disallow the expense. And when they disallow the expense, they basically add it back to your income, and now you have to pay taxes on it. And you just don't want to do that. Here is an example of a tax notice. So I just wanted to tell you, I wanted to remind everyone that businesses that started out as sole proprietors, this notice is because of this thing right here, this story I'm about to tell you. Businesses that start off as sole proprietors, so you start off, then you get your merchant service account, so you get your PayPal account, you get your Shopify account, you get your bank account, and you just start everything because you started your business, of course. But then you actually incorporate. So now you've incorporated your business. And there is a form called 1099-K that the IRS for merchant services, if you make over, like, I think it's 20,000 or more, they give you a form 1099-K, which reports your money to the government. So merchant services, like, because you take Visa, MasterCard, even PayPal, but once you make over 20K, then these merchant service providers or businesses report your money to the IRS. And if you have not changed your numbers, your EIN number, or given the information to the merchant service, if you have not updated them, what happens is they send a report to the IRS under your Social Security number, and then you get a big tax bill. So you just want to be careful that once you start transitioning from sole proprietorship, you need to then go back and correct all of your merchant accounts and make sure your merchant account has the correct number. I have seen this example time and time again, and this notice is it's not fun to get. It's not fun. And you just want to keep your documents in order. This one, you can't see that well, but this was an audit that happened with one of my clients. And basically the auditor said, because they didn't have proper documentation, we disallowed your car and truck deduction. We disallowed your credit card and bank account statements. Actually, the IRS is still a little bit antiquated, and they want receipts. I know receipts rub off. Like I said, take your trusty little cell phone, and you can start a receipt management documentation system, which is cell phone and a Google Drive folder, or cell phone and an Apple iCloud folder, and monthly you take pictures of the receipts, because if you get audited, then you're going to have to show receipts. Now, I want to give you an example. So, for example, if you go to Walmart, and we know at Walmart, you can buy pajamas or you can buy office supplies. You can buy your kids some clothes, or you can buy a computer for your office. Just because the charge says Walmart does not necessarily mean it's a business expense. That's an example. So if the auditor selects your office supplies as a category to review, meaning they're going to investigate a little bit more, then they're going to ask you, okay, we see $24,000 reported on your tax return. We need $24,000 of receipts to support this deduction. So keeping your receipts is not something to be loosey-goosey about, because there are some horror stories, and the horror story is you're going to owe the money. In my office, in my practice, I ask the client to give me their expenses, and then I make them sign, well, I'm doing it now for sure. I make them sign off that that they have the receipts for the documentation, because I don't have to do bookkeeping to do the tax return. But if you get an audit letter, I like to actually protect my returns from the IRS. Protecting them from the IRS means that each line item on my return has support and documentation. So it's something that you want to consider. It's something you want to do better. You want to do a better job with keeping track of your receipts and your business documents, because you're in business, you're a boss. And that's what, you know, a boss keeps proper records. It's just part of it. And so you don't want to be loosey-goosey with it, and you don't want to put it at the bottom of the totem pole, because if you ever get audited, it comes back to bite you, and it usually happens at a most inopportune time. Okay, so I want to talk a little bit about some tax strategies. I'm not going to go too deep dive because we are going to have like an October tax strategy session. It's going to be all an in-depth dive into these tax strategies, but I want to go over a couple of them. So there's hiring your kids or your elderly parents. So what happens is with the tax law change in the year, I think it was like 2018. 2018 has been 2 years with the Trump tax law changes. The standard deduction is $12,000. So what you can do, and I'm pretty sure you've heard hearsay, or you keep seeing people post on social media about hiring your kids, and you're like, is that true? Yes, it is. This deduction has been around since the beginning of time. I want to say our counterparts in other nationalities maybe have taken advantage of it, but we're catching on, which is awesome. So hiring your children in your business. What happens is up to $12,000 as a standard deduction, you could pay your child $12,000. You can pay your child $12,000, and then it would be tax-free, because the standard deduction, and I don't want to get too technical, but the standard deduction is $12,000. So then when you pay the child, and this is for each child you have, when you pay the child $12,000, then it's really a tax-free deduction. So your business gets a deduction of $12,000 per child. And then when you file you don't actually have to even file a return for the kid, because the $12,000 is under the standard deduction. Now, what I'm going to do in our practice is we're probably going to do W-2s with a line item for the kid, but not to get too explicit into this. And I'm going to talk about elderly parents too. When you're hiring your kids, what you're supposed to do is you must have proper documentation and support. And what that means is you should have a proper timesheet, just like you would hire anyone else. If it's and for kids 7 and under, what you would have to do is hire them to be models, because typically a kid 7 and under is not much value in the business. 7 to 18, you could have your kid working. So for example, my daughter, she's 14. I actually have her now working in my office. She fills out a timesheet. She had a little joke with me about the labor laws. I don't know, she looked at my labor law poster and she had enough behind her, because she didn't want to work long hours anyway. She's smart enough to look at the labor law poster and read that kids under 4 or 14, whatever age it was, can only work 4 hours. But I believe if it's your child, now I'm not going to talk about labor laws. That's not my lane. But anyways, you can hire your kid, you get a proper timesheet, or they should give you some sort of way that you capture their time for the job that they did. Now, an elderly parent, you can do the same thing with the elderly parent, but this is an elderly parent that does not have much income, because really this strategy it's called shifting income to a lower tax bracket. What we're doing is we're taking $12,000 of business income, and depending on if we're multiple six-figure earners, and we have, and what that means is our tax rate, our personal tax rate, is probably 25 to 30%. So by transferring $12,000 to the kid, you are saving $3,600 of taxes. It saves you, if you're in a 30% tax bracket, you take that amount of the deduction, $12,000, multiply it by the tax rate, and that is how much you save. That's pretty significant. That's a significant savings. Elderly parents. Now, you have to have a parent. If you got a parent that got a bunch of pension income and a bunch of investment income, that parent doesn't qualify, because that parent is not in a low tax bracket. So for elderly parents who have Social Security and they do not have much income, they're in a low tax bracket, you could pay them. And and I want to tell you guys, it didn't have to be $12,000. It could be a little bit more, because I think the child or the parent, and let's exclude Social Security income because there's some specific rules around it, but the child or parent could hold up to $20,000 of business income transferred to them, because up to $20,000, you're in a 5% tax bracket. So what you're doing is you're transferring money from a 30% tax bracket down to a 5% tax bracket. I'm pretty sure this can work with your niece, nephews, and blah, blah, blah. But the IRS has special rules for hiring of your children. And then elderly parents are usually, they're done working. And some elderly parents that we take care of, they're in lower tax bracket. Then there's the strategy of personal expenses to business expenses. Let me give you a few examples. So your car is one of those personal things. If you work at a W-2 job, you get no write-offs for your car. Well, in your business, you can write the car off. And that's what we talked about, mileage. There is your home office. There is your cell phone. There is traveling for business. These are some things that could be personal that we could create a business expense. But like I said, every expense that we take is all about documentation. If you are doing business travel, you need to document it. So what that means is if you're going to a conference and your conference is Friday, Saturday, Sunday, Monday, and just say you attend the conference Friday and Saturday, and then I guess you're going to do the follow-up day on Monday. Well, then you can write that off 100%. So, but whenever you have business travel, it's all about, if you're going to have business travel, then you should conduct business. And whenever we conduct business, we have sent an email, we have made a phone call, we've scheduled something, put something on our calendar prior to traveling, so that we could, if the IRS asks us about this travel, we have like, hey, I met with so-and-so realtor, we discussed this and this and this, and this is why I traveled for business. And that's how you get the tax write-off. There is self-employed pension plans, there's solo 401k, there's a self-directed IRA, which I like a lot. But today, those things are retirement expenses. And what happens is when you have profits, 6 figures or more, or just profits, period, you can take up to 25% of your profit and you can put it into a retirement plan. And if you're one of these business owners, because for some reason I'm meeting a lot of business owners that have all these multiple entities, you could, if you have a self-directed IRA, you could take that, you can put money in the self-directed IRA, and that's, you can put money in self-directed IRA and you can use it to start another business, but there are rules and exceptions. So there's some specific rules for each scenario, but it's a possibility. That's what I want to tell you about. It's a possibility. There is transferring your single member LLC to S Corp. That is one of the first strategies that I would implement with a growing business. And like I said, from the time you make $25,000 a profit to more than that, as a single member LLC, I would like to see you as an S Corp because it's a tax saving strategy due to the FICA and Medicare. Then there is an S Corp accountable plan. What that is in your S Corp, basically you get a deduction for all of those things that I said, going from personal to business. You track them just like when we were at those corporate W-2 jobs and we had expense reports. So we track our home office expenses, we track our personal cell phone, we track our supplies, we track all of these things, and then we issue the document to the S Corp, and the S Corp will reimburse us for those expenses. But this is a strategy on how you can it's almost like claiming rent for your home office. And I know now that home offices are very popular because it's COVID and we're at home and we're all working from home. So your S Corp can adopt an accountable plan, which that is it's a legal document. I will have an accountable plan strategy session coming soon, but it's a plan, a contract, plus you have to do the reimbursement. And as long as you follow the rules, you can optimize this tax strategy. Then there's tax planning for wealth builders. Like I said, it's a multiple entity strategy. We create 2 to 3 strategies, and once again, we're shifting income to lower tax brackets. So if I had an S Corp and a C Corp together, then I probably would make my C Corp the management of the S Corp, And then I can pay the C Corp because any money in the C Corp is taxed at 21%. And if I'm personally in a 30% tax bracket, once again, I'm shifting money to a lower tax bracket to be taxed at a lower amount. And sometimes in a C Corp, if I'm trying to not hide cash, but if I'm trying to conserve cash and I'm growing my business and it's going to be very liquid, I would also utilize the C Corp. Okay, now let's schedule a strategy session. If any of these topics that I have said tonight make sense to you and you want to do a deeper dive with the strategy session, I have something called Know Your Numbers Strategy Session. I'm going to have my contact information on the next slide or two, but I'm saying, will you be our next success story? I've had so many good strategy sessions, like Know Your Numbers sessions lately. Yesterday I had it was a couple and they had like 6 entities. So on their strategy session, they were like, what is the best tax strategy for my entities? And then we broke it down. Then what else? If you want to understand about hiring your kids, if you want to understand, well, how can I pay less taxes? If you want to understand, how can I get organized with my finances? What do I need to do? If you want like to do that pro forma, do you want a cash plan? Now on the strategy session, it's only 1 hour. And so what we do is we will do 3 to 4 months of your cash pro forma plan. But you could just, whatever is bothering you in your business, specifically as it relates to your financing, your taxes, you could feel free to have a personalized session with me and I will answer the question and help and support you however I can. And then I just want to tell you guys to hire a good accountant, or at least an accountant that is specific for your need. Honestly, just like doctors, there are foot doctors, eye doctors, nose and throat doctors. So there are different accountants for different situations. So you want to know who the best professional is for your situation. I find that a lot of businesses, as they're growing, they are still going to their personal tax person who did their personal taxes. And that was good for where they were. But as you're in business, you want someone who's used to doing business taxes and dealing with business tax issues. And there can be a lot of them. And but good accountants, they understand the language of business, because accounting is the language of business. You're in business to make money. Accountants help you track and keep order with that money. The financial information helps a business owner to make informed decisions. All successful businesses, in all honesty, have an accounting department. Target has an accounting department. I'm pretty sure, what is the company? I want to say Amazon has an accounting department. Mariano's has an accounting department. Any successful business has an accounting department. I know we're smaller than that, but we have to get a semblance of all of these like different departments. And honestly, that's HR, accounting, legal. So you want to have your money team, even the financial planning people. You want to have like a money team, and you want to have a team around your business when you have the intention of growing it. Because you don't have to be the expert. You don't need to spend 3-4 hours frustrated with QuickBooks when you should just hand it off, because that's time that you could use to make and create in your business. You can make more things in your business if you had more time. You don't need to struggle with something you may not be subject matter expert on. Okay, I can be found at Facebook at Tax Boss Lady, Twitter at Glance Financial, Instagram at Tax Boss Lady. And I want to say I have a free 12-month cash flow statement I could send you. And anyone who wants to schedule a session, I'm asking you to text 312-265-2977. So text 312-265-2977. I could send you the 12-month cash flow statement. I'm going to need your email address. I can send you the 12-month cash flow statement, as well as I could send you the link to schedule for Know Your Numbers. Yeah, okay, so now it's Q&A time. So anyone that has questions, let me know. Let's answer these questions. Okay, Q&A. Oh, I see got some questions from, Okay, so Bridget, what if I have an LLC partner? When do we file? Okay, as an LLC, you filed, the tax return is due March 15th. A lot of business owners actually don't know this. If you have a partnership tax return or S Corp tax return, those returns are due by March 15th. So you must file the business tax return first. What will happen is you'll get a Form K-1, and then you're able to file your personal tax return. This is why the flow-through entities, partnership returns, S Corp returns are due March 15th, and then the personal tax return is due April 15th, because it gives you time, because you need to file the business first, then you file the personal tax return. Okay. Question number 2 from Allie. Okay, if I am a single member LLC and I want to be taxed as an S Corp, when you create the LLC, you should file the form immediately, or you can do it at tax time. Would you recommend a single member LLC to do this if they make over 10K per month? Definitely. If you make over 10K per month, I would say go ahead and send in the S Corp designation. It is Form 2553. Now, yes, when you initially incorporate, you have 2.5 months to file the 2553, or you have to file it at the beginning of a calendar year, and you have until March 15th. However, let me tell you, Allie, there is strategy. And so sometimes as a tax expert, I may even amend your returns, because there is a loophole where with the S Corp, we could send a letter to the IRS to elect the late election and then amend the returns, because the S Corp strategy is significant tax savings. But I would say definitely your 10K per month, you definitely should become an S Corp. But with an S Corp, you should pay yourself a payroll. And once you get with your tax advisor or your accountant, or you could book the Know Your Numbers strategy session. And that's something we could talk about and discuss, because this is significant. Say there's at least 10K of savings switching to S Corp strategy, because right now you're potentially paying the self-employment tax, which is 15.3%, plus your ordinary tax rate, which I'll say is the 30%. So you're technically paying like 45% in taxes. Well, maybe not, but at least 40 cents on the dollar in taxes, because you're paying self-employment tax on every amount, on every dollar of your profit, plus you're paying the ordinary taxes. That is why the S Corp strategy is definitely for you with 10K per month of income. All right. If you have a personal bankruptcy, but you have an LLC, should you elect to file as an S Corp? Okay, now bankruptcy kind of goes into more legal matters, but what I want to say is if you have an I don't know if your personal bankruptcy, that question I would have to research a little bit more, because I know as an S Corp, what happens is the money is transferred to your personal account. And I have clients that have certain situations, and I want to say they got situationships, and whatever that means, not an entanglement, but a situation. And it could be because they're on disability. It could be for whatever reason, they don't want that money reported on their 1040, because S Corps are flow-through entities. So what they do is they form a C Corp. A C Corp is a standalone entity. And if you have any situations, because the C Corp, you can always elect to make it an S Corp later. So the C Corp, I would form a C Corp, kind of get through my personal situation, because the C Corp would not report back to your personal, get through your personal situation, and then you can always make it a subchapter S later. Okay. If I have 3 partners in my LLC, is it best to have a C Corp manage the LLC or have them under the C Corp umbrella? Is there a difference? Okay. This is what I like. If I have 3 partners in my LLC, only because it's 3 partners, it's 3 different personalities, 3 different people, and you're splitting the money 3 ways already. I kind of advise the business owner, the owner, not to have the C Corp for their partners, but kind of own your own C Corp so that you have something that when your money from the LLC, it can flow to the C Corp, and I probably will make it an S Corp, but it could flow to the S Corp, and then you have the anonymity or whatever it is to make decisions for yourself. So then that way you don't have to ask them about, well, how much am I going to put into the pension plan? How much could I spend on this car? How much, whatever it is, should I pay for health insurance? About when it goes to hiring your kids, you know, it didn't have to be split and decision made 3 ways. But just off of entity structure, could you have a C Corp manage the LLC? I also talked about tax strategy. So the C Corp is a lower tax rate. So yes, you could have the C Corp. The LLC, I would say the LLC, a C Corp is a member of the LLC. So that's what happened. So the C Corp is a member of the LLC. So money from the LLC goes to the C Corp, not the other way around. Not the other way around. No. Are there any more? Oh, you're welcome. You're welcome. Are there any other questions? Like any other questions? Because I'm here. Like I'm offering my Q&A for any other questions. Anyone curious about anything? You can do anonymous. If not, I want to thank everyone for joining me tonight. I so appreciate this. Thank you so much. I will be having another webinar on September 30th at 7 o'clock. And thank you, Danita. Thank you for joining me. I'll have another webinar September 30th, and actually we'll be doing these monthly. When we get to October, we're going to do a deep dive into like more tax strategies. But this is just an overall information session. Thank you so much. Thank you. I appreciate you. Thank you. Have a blessed day. Bye-bye, everyone.